Let's get into some earnings, particularly those breaking out to highs. That's the case for SEI as the business gets to multi-year levels post-earnings. Shares have been ripping. Joining us, the CEO, Ryan Hicke at SEIC is the ticker, SEI Investment. Ryan, thanks for being here on the Schwab Network.
Thanks for having me, Oliver.
Okay, tell us about your business, because I know there's a lot of investment themes, a lot of financial business at the core, but you guys have also got a tech side as well, from it seems kind of a consulting element as well. What's the biggest driver of the business right now?
Yeah, if you think about SEI, kind of unpack it into three core pillars, if you will, Oliver. We have a technology pillar, we have an operations pillar, and an asset management pillar. And then our client base spreads globally, but we really have everything from investment managers who outsource really the technology and operations to SEI, to institutional clients, financial advisors, and banks that take a combination of one or all of those pillars.
Understood. Lately in the market, we've been a little bit worried about some of the regional bank stuff, the lending aspect of kind of fixed income focused businesses on the financial side, but it seems like you guys might be a little bit more tied to kind of the general direction of the stock market as an asset manager.
Yeah, I mean, about 78% of our revenues are asset-based, but our client base is pretty spread. But as you mentioned, in that regional bank space, we have a lot of clients in kind of the large bank all the way down to the regional and community bank space. One trend and dynamic, though, that is definitely kind of working in our favor is because of, I think, the kind of industry dynamics, the interest rate environment. Over the last couple of years, a lot of these firms have had to really try to rethink, what does wealth mean inside a bank? And a lot of our capabilities really enable our clients to accelerate their position and their services around trying to diversify their business, maybe away from just the credit side to more of a holistic wealth management offering.
One of the other trends we've been hearing a lot about is private banking as well. I know you guys have an arm in that too. Have you seen a pickup in interest in that sector?
Yeah, definitely. And especially across, as I mentioned a couple minutes ago, that regional and community bank space. But now you're starting to see a lot of the larger banks, again, kind of reemerge with some thoughts and conversations around how do they upgrade their legacy technology platforms? How do they become more digital for the future? That really lends itself to a lot of our capabilities and the technology that we have and that we've built over the past few years. And then when you think about the offering, the other trend that is really hot right now, I don't have to tell you, is really that intersection between private assets and intermediaries. So we do a lot of work with some of the world's largest investment manufacturers, especially in the alternative space, that are trying to figure out how to get their solutions and products in the hands of more retail customers. And a lot of our intermediary clients, whether they're banks or financial advisors, are trying to figure out how to incorporate those products into their portfolios. I think we're in the early innings of that game, Oliver, and there's a big education process required on both sides of that constituency.
Interesting. What are those types of products? I mean, do they kind of fit a general bill on what's hot? What is the pitch, the sales pitch in the product that they need to connect with everyday folks?
Yeah, I mean, I think if you start at the top, right, there's just an overall trend of how do you diversify the portfolio with the incorporation of alternatives. Obviously, the private credit space is very hot right now. CLO funds, figuring out how to get those into either a 40 Act structure or make those a little bit more consumable to an intermediary or a retail client. But I think people are starting to step back and they'll try to understand what are those asset classes, what diversification do those asset classes bring to their portfolio. But as I mentioned a few minutes ago, trying to make sure we're arming the advisors with the education they need to make sure they're explaining these products correctly to their end clients, and really working with some of the manufacturers to help them understand kind of the differences of intermediary distribution versus institutional.
How much of that demand for alternatives started about 18 months, 2 years ago, when stocks and bonds are both getting killed at the same time? I imagine that if we kind of normalize that relationship, it might help, but that traditional portfolio tore everybody up in 2022.
Yep. I think you're absolutely right. I think that was kind of a catalyst that really accelerated it. I mean, I don't have to tell you, I think there's been a big trend, obviously, over the last 7 to 10 years. We see the movement out of kind of large actively managed mutual funds across the industry, more investment into ETFs, different product types. But as people look across that landscape, they're really looking for different sources of alpha and different sources of diversification. But I think you're absolutely right. The last 18 to 24 months, this has really picked up.
Okay. So what next then? Your stock's breaking out to multi-year highs here. Market seems to really like the earnings. Your assets under management surprised to the upside at a time where, as we've been talking about, there's a lot of kind of finicky trading around financial institutions. What's the plan going forward?
Yeah, I mean, I think the market likes our stability, honestly, Oliver, right? We have a great balance sheet. We have a great client base. We have leaned more aggressively into kind of growth-oriented investments over the last couple of years. We're staying really disciplined on the expense side. I think we definitely got rewarded for kind of expense management. We're going to continue to do that. But I think if you step back and look at SEI, I think one of the things the market's starting to get excited about is the breadth of our client base. And if we can start to really avail more of our services to those clients, we believe there's a lot of growth potential there. Honestly, we think if we continue to execute and service our clients really well, we'll continue to see significant growth. That's what we're hoping for.
M&A, acquisitions, consolidation. Give me a thought on that real quick, Ryan.
Yeah, we've been a little bit more aggressive than in the past. That's a relative statement. SEI has historically grown organically. We've made a couple acquisitions. We think about that a little bit differently, Oliver. We look at that as what could we do to accelerate some of the strategies we have in place, whether that's around capabilities or talent. I think the consolidation in the RIA space will continue with the aggregators and roll-ups. So I think that's something that we're kind of watching and looking at how that impacts our business. But I think overall, there's obviously been a little bit of a slowdown in the overall M&A space. I think it's just a matter of time before that picks up again. We tend to focus a little bit more on the SEI side on organic growth. We like medium to long-term plays where if we think we execute right, our shareholders will be rewarded.
Okay. Being rewarded right now, post-earnings. Thanks for the explanation, Ryan. Yeah, congrats, and we'll be in touch.
Thanks for having me.
Sure thing. Ryan Hicke, CEO at SEI. SEIC trading $66, just $3 away from the pre-COVID high of $69.61.